Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy.
Hopefully you've all either had your summer holidays or looking forward to your summer holidays. I hope the weather in the UK improves. It hasn't been particularly great over the last week or two. But I certainly think there is some reason to be more optimistic about the prospects, not only for the UK economy, but for the global economy going forward. So without further ado, we're going to pile into the presentation, which should last about 20 minutes. Then there'll be plenty of time for your questions afterwards. So we'll look first and foremost at the economic activity figures. Now, we've had figures from the US and Eurozone. We're getting the figures from the UK tomorrow. So the figure that you'll see in the slide coming is going to be the one that is estimated. That's what the market consensus is, and there's a highlight on that. And I will update that slide once the figures are actually released. Then we're going to look at the COVID numbers and see how they're going. Certainly, there have been some increases, not just in the UK. Although the UK numbers look as if they've plateaued, but also in Europe and in the US recently. So we'll look at how that might affect things and how we might start to consider the autumn and winter months and whether there's the need for renewed restrictions. Then we're going to move on to labour markets. I think there's some interesting stuff behind the scenes in the labour market data. If you look at the US numbers, everybody tends to focus on non-farm payrolls. If you look at the UK numbers, they tend to focus on employment. But there's other stuff that I think is interesting there that we need to just spend some time reviewing. Then we'll look again at commodity prices. I looked at this last month. We're going to look at it again because there does seem to be some signal from the commodity markets that prices may have peaked, at least in the short term. And then we'll follow up with a look at what our FX forecasts look like now. There have been some changes there, so I do hope that you weren't putting too much stock in us achieving the rates that we were indicating. We have revised the sterling and euro numbers slightly lower against the dollar in light of some of the changes that we've seen economically over the course of the last month or so. So let's move on to the first slide and let's look at economic activity and what's happening there. And you can see here very much that we are on an uptrend again as far as quarter-on-quarter economic growth is concerned. But of course, these figures are skewed by the big drops in economic output that we saw around about Q1, Q2 of 2020. Now, the GDP growth in the US, it was around about 1.6% quarter-on-quarter. In Euroland, it was much more subdued in terms of economic growth. But in the UK, it's expected to be close to 5% quarter-on-quarter. Now, a lot of that is down to the fact that we did see an additional dip in economic activity in Q1 because of the renewed lockdown. So that's one of the reasons why that figure is going to be skewed. And also, a lot of the services businesses didn't really reopen for the last couple of quarters. So in Q2, you've got that latent effect of pent-up demand that will have offered additional support to economic activity. Now, we expect more growth to come in Q3, albeit of a lesser order of magnitude for the UK. But the UK does look as if it's on track to meeting the sort of 7.5% growth forecasts that most of the major forecasting organisations expect. Bank of England actually is still expecting the figures to be even that. They're expecting growth of an order of magnitude of around 9% for the year 2021, and then a further over 6% in 2022. So a very, very rapid rebound, which means that we should re-achieve pre-pandemic levels by the end of this year and then be considerably above those by the end of 2022. And I'd also stress that as far as the Eurozone is concerned, there's probably going to be some fairly healthy growth numbers in Q3 as well. In fact, Eurozone growth could beat the UK and the US in the third quarter because, again, of renewed restrictions that occurred in the second quarter. So we've got an ongoing US recovery, although it's facing more challenging conditions now to maintain the pace of economic recovery. And we're expecting to see a faster pace of economic growth in Europe and in the UK over the course of the second half of the year. Moving on to the next slide. Now, this looks at the COVID infection numbers, and yes, infections are still elevated. In fact, in the UK, we had that dip after the peak, but we seem to have stabilised, and that is most likely related to the renewed lifting of restrictions. So the UK went for a big bang as far as the lifting of restrictions were concerned, and lifted all restrictions at once for the domestic economy. And as a consequence, that has led to some rebound in the infection numbers. But we are seeing, in terms of the number of people on mechanical ventilators and the number of people in hospital with COVID, those numbers are beginning to drop. And so that is encouraging news. So it does suggest that we're not going to hopefully see a renewed peak above the previous peak that we saw in COVID infections. And what is also encouraging is the level of hospitalizations, and that's regardless of whether you're looking at the UK, the European Union, or indeed the United States. Levels of hospitalizations have generally been lower, in spite of the fact that in some states in the US, you've had record levels of COVID infections, and indeed in the Eurozone, you have seen the renewed threat of a new variant. In this case, it's the Delta variant, which has caused some consternation amongst health officials. So the numbers are still, we're still cautiously optimistic about the COVID numbers. But of course, if we still remain at these sort of elevated levels of COVID infection rates heading into the winter months, that could bring about a renewed restriction having to be put in place, whether that's in the UK, in the US, or indeed in the European Union. So there is still a lot of scrutiny here. There's still a lot of scrutiny in terms of the number of COVID deaths as well. Those COVID death numbers, there have been a number of articles in the press recently suggesting that there's a greater concern amongst health officials that people are still not going to hospital with other health problems because they fear that they're going to catch COVID when they get into hospital, and that could be the end of them. So there's a skew in terms of the ONS data on death numbers, which show the number of death numbers are still elevated, but it's not necessarily related to COVID infections. As far as the COVID numbers are concerned as well, the other thing to continue to watch out for is vaccination levels, which in the UK continue to be very encouraging, as they are in the Eurozone. In fact, in the European Union, we are seeing a number of countries now surpassing the UK's vaccination rates. In the US, there has been a drop-off in the level of vaccinations recently, but there's still a very significant minority of people that haven't even received a single dose of these COVID vaccines. So that could lead to renewed outbreaks as far as COVID infections are concerned. Moving on, looking at the next slide, labour markets. Now, I said that people have tended to focus on the headline numbers of employment or non-farm payrolls, whether that's the UK or the US. This is another measure of either labour force participation or the employment ratio. So these demonstrate whether there is a significant problem as far as rates are concerned. Now, if you look at the US participation rate, yes, it's picked up from its post-COVID lows, but it does seem to be struggling to make further headway. So that's the dark blue line, back to where it was. And it was on a downward trend over the course of the last decade from previous levels of participation. If you look at the UK's numbers, there's been relatively little sign of recovery in terms of the employment ratio. And that indicates to us that the level of non-participation could be being increased. Moreover, the risks are that we may be embedding this lower level of labour supply, and that could prompt a higher rate of average earnings growth and wage inflation, which could then be baked in to the US and UK economies. And the reason we should be fearful of that is that even without that, you're seeing central banks wanting to raise interest rates as far as the UK is concerned, and certainly tighten monetary policy as far as the US is concerned. Question marks still remain. Which will central banks choose? Will they choose the prospect of raising interest rates, albeit in a limited fashion first, and then reducing the level of asset purchases? Will they look to reduce the level of asset purchases more immediately? Will they look to combine a reduction in the level of asset purchases with some limited rate increases? It's still not clear as to what route they are going to take, although the Bank of England have, I think, been a lot clearer than the Federal Reserve in that they want to make some limited rate increases, probably to take interest rates to 0.5%, and then they will focus the majority of their attention on reducing the stockpile of assets purchased. As for the Federal Reserve, I think the indications from the dot plots we've seen are that interest rates will rise up towards 1.5% over the course of the coming years, but probably that journey won't begin until late 2022. Similar for the UK, it'll be late 2022 or early 2023 before interest rates start to rise. So moving on and looking at commodity prices, I mean, this is another element of inflation that has been concerning for central banks and could be adjusting rate hike expectations. We've seen the oil prices rising to fresh multi-month and in some cases multi-year highs. But oil prices have slipped back in recent weeks. The CRB index as well, which is a measure of a basket of commodities, also seems as if that may have peaked as well. There seems to have been some improvement in supply chains, but there is still some disruption in terms of shipping and logistics that I think needs to be worked through. So you may well see, even though commodity prices have actually peaked, that the price paid at the consumer end of the spectrum will continue to rise for a few months yet. And there are plans for commodity price rises, particularly in things like building materials, in the pipeline over the coming months. So those rising commodity prices and those logistical and supply chain disruption problems will still be a factor in central bank thinking, and therefore will be a factor in terms of what happens with regards to currency markets. I think we are starting to see the central banks becoming slightly less sanguine and certainly slightly less relaxed about the overshoots that we're seeing on inflation. I'll take the Federal Reserve as an example. You had two Federal Reserve members, Barkin and Bostic, talking about the fact that they would support an earlier end to the quantitative easing purchases, the asset purchase programs that are in situ, and they'd probably also support an earlier hike than is currently priced in those dot plot assessments. So that gives you some indication that a combination of rising commodity prices, but also labour shortages causing wage inflation, are starting to have an influence on central bank thinking. Moving on to the currency markets before we get on to the Q&A. One of the trends that's been persistent over the course of the last month that we were expecting there to be some respite from is the weakness of the euro. We've seen it trading down into the low 117s against the dollar lately. We may well see further short-term pressure for the euro, but there are some question marks over how long the dollar resurgence can last, particularly when you've seen the likes of the US Senate passing a $3.5 trillion infrastructure bill, infrastructure and social care bill, things that will help to improve the carbon footprint of the US economy, but also that looks to address poverty, it looks to address social mobility, education, particularly adult education, childcare, all of these things. $3.5 trillion is an awful lot of money that the US is going to spend. Equally, they're going to raise some of that through tax increases, but some of that will be piled on to the stock of US public debt. And I think that could put some pressure on the US dollar as we head into the end of 2021. Remember, we've got midterms in 2022 as well, November 22 for the Senate and Congress midterms. And I think that could be used as a stick to beat some of the more moderate Democrats in states where the Republicans will mount a significant challenge. Moreover, I think there's another issue at hand here, which is that we are seeing Asian currencies and Asian economies coming under pressure because of a renewed rise in COVID infections and the need for renewed restrictions. We've seen that in Japan throughout the Olympic Games. So there are some pressures likely to be brought to bear on Asian currencies as well. And that may divert attention away from those, and if the dollar is under pressure, it might favour the likes of the euro and sterling heading into the sort of final quarter of 2021 and the first quarter of 2022. Arguably as well, I think that there is more limited upside for sterling than there was. We've talked on previous calls about the fact that the markets are now well priced for the upside as far as the economic news is concerned from the UK. And consequently, I think that it's unlikely that there's going to be material upside surprises from the data or surveys from here on in. Starting to see a slowdown in house price inflation, according to the latest figures. We're also starting to see some of the data and surveys undershooting expectations on a month-by-month basis. So sterling's upside is more limited from the domestic sources of data, and it's probably going to rely on some weakness from the US dollar rather than any strength from sterling. That's really it as far as the presentation is concerned. The final slide is just a disclaimer that you've seen many times before.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.